Hi, this is Karen Lin. This is the study guide for Financial Accounting Week 2. Last week, we talked about how total resources can be funded by different sources of resources, including those funded by the creditors, those funded by the owners, and those generated by the manager who runs your firm and kept in the firm. Now, it means that, for example, the manager earned $100 net income, right, and paid out $40 dividend. How much is the management generated resources and kept in the firm? That's $100 minus the $40 dividend. That is the $60. This general equation can be translated into an accounting equation, which is assets mapping to total resources equals to liabilities mapping to the borrowed resources and stockholders' equity mapping to the owner's invested resources and the management generated resources and kept in a firm. Again, the part that's not kept in the firm is the dividend. So management earns some money, pay out dividend. The part that's left in the firm is the management generated resources and kept in the firm. Owners invested plus management generated resources and kept in the firm are called stockholders' equity because they both belong to the stockholders, not belong to the creditor. So, what are assets, liabilities, and stockholders' equity? We have formal definitions of them. So, assets are the resources that controlled by a business, which will bring future benefits to the firm. Examples including cash, accounts receivable, all those things will be used in the firm for the firm and then bringing future income to the firm. For example, if you don't have cash, you can buy materials, you cannot perform your operation. So those are the things we need. Remember our first class, we need things to sustain our operation. Those kinds of things will bring future benefits to our firm. Liabilities are resources of borrowed sources of borrowed resources. So they are the claims of a creditor to a firm's resources which the firm needs to be paying back in the future. So if you owe the bank money, if you owe the suppliers money, those are to be paid back in the future are all called liabilities. Stockholders' equity. Stockholders' equity are the resources owned by the owners, right? So as we talked about in the previous slides, it includes the owner's invested resources and the management generated resources that are kept in the firm. Continuing our discussion this week, we are going to introduce T accounts, debit and credits. What is a T account? A T account looks like just like a big T as is shown in the picture. So there's the title of the account, for example, a cash account, you would write cash here. And the left-hand side of this account is called the debit side. So it is short form as DR normally. The right-hand side is called the credit side, which you short form as CR. When we use the T account, there's a rule of the T account that we have to remember. Now, as you would recall, accounting equation has always to be equal. So when we use the debit and credit accounts, the rule is that if you have a debit, you must have a credit and they must be in the same amount. So for example, if you buy supplies and pay cash for the supplies, you pay $50. If that's the case, you would debit supplies and credit cash for $50. When you debit supplies, you cannot leave your credit side empty. It has to be the same amount of debit and credit, and you have to have debit and credit all together at the same time. Again, as I said in my welcome letter, accounting is a language of business. So why this is a language? If someone knows accounting, they look at the debit and credits you have made, they would know that when you debit supplies means supplies increase. When you credit cash, it means cash decreases. So if they know the language, they know, okay, you pay cash because cash decreases, and you got supplies because supplies increases. So it has a meaning, but you have to know the language to decipher the meaning. Now, you would ask me, how do I know increase or decrease? Here is how. So for each type of accounts, right, each account belongs to any one type of these categories. They have different rules regarding debit and credits. For example, if there is an asset account, which is in this case cash and supplies, they both are asset accounts. When an asset account increases, it increases by debiting that account. For example, your supplies increase, you debit supplies account. When that account decreases, you credit that account. For example, in this case, cash decreases, you credit cash. Okay, so when we know one account belongs to an asset account, that account increase, we debit it. If it decreases, we credit it. The normal balance means what is the normal sort of at the end of the day, you look at your account, where is the balance of that account resides. For any asset account, normally the balances, ending balances are on the debit side. So that is how you read this table. So there's all these different categories, they have different rules. For example, for liabilities, it increases by credits, decreases by debits, and the normal balances resides on the credit side. Now you would say, okay, this is really difficult to remember because this is a table, um, 6 categories and 6 by 2, right? It's 12 different things that I need to remember and then the normal balances that I need to remember. So I can just tell you that the normal balances is always, almost always, uh, the, the side that this account is increased by. For example, if asset increases by debits, normal balances will be debit. This is the assumption that we normally would increase something more than we decrease it, right? We don't wouldn't really have a negative cash account. So we always assume cash increases for our firm would be more than the cash decreases for our firm. Of course, there are exceptions in reality, but we don't talk about it in our financial accounting courses. So it's very difficult to remember, as we said, but here is a trick to help you to remember that difficult table. So how I remember it when I learn financial accounting is that I decompose all the items around my accounting equation. So I have asset equals to liability plus stockholders' equity. If you remember at the beginning of this video, I talked about stockholders' equity includes the common stock, which is the owner's invested resources, plus retained earnings, which is the management generated resources and kept in the firm. Because this is a cumulative number, so retained earnings can be decomposed into this is the cumulative ending balance of retained earnings that equals to the beginning of retained earnings plus revenues that earned during this period minus expenses during the period minus dividend. Now, revenue minus expenses, basically it's how much the manager earned for the firm. So that is the earnings part. Dividend is the payout part, right? Payout means it's not kept in the firm. So if I have earnings minus the payout, the rest would be the retained earnings. So again, asset equals to liability. If I expand this equation, asset equals to liability plus common stock, owners invested, plus retained earnings from the beginning, plus revenue, minus expenses, minus dividend. So this equation you can remember through your common sense of the accounting equation. Once I once I decompose my equation into different accounts, type of accounts, let's look at the debit and credits. Now I only have to need to remember that assets always increase with debit and decrease with credit, right? This is easy to remember. If I have a cash increase, I debit cash. If I have a cash decrease, I credit cash. So I always remember assets increase with debit and decrease with credit. Now, on the other side of the equation, because it's the other side of the equation, everything should flip. So when I'm increasing any asset account with the debit side, I would increase all the liabilities, any liability account with the credit side, and liability accounts decrease with a debit side, right? So similarly, if I look at common stock retained earnings and revenues, they are all following the same pattern, increasing using the credit and decreasing using the debit. But you will find out not all accounts on the right-hand side are increased with credit. Why? Because if you look at the sign, these two items have a negative sign before it, and all these other items have that sort of the positive sign before it. So when you see a negative sign, you know that it's flipped again. So if you compare expenses and revenue, expenses would be the opposite side of the revenue because they have different signs before it. So we know that expenses and dividend, they are following the pattern of the assets because they flip from these other items that has the positive sign before it. So when an expense increase, it increases with debit. When a dividend increase, it increases with the debit. So this means you don't really need to remember the table that I showed you a moment ago. You can derive this debit and credits rule by expanding my accounting equation to a full size, and then I can remember the debit and credit rule among those categories. Now you would ask me, why is it related to the accounting equation? That is because the rule we are using, the things we are doing, debit and credits, all that we do are trying to keep our accounting equation equal. That is why when you have a debit account, you must have a credit account at the same time, and they have to be in the same amount. So that is the idea. um, you would still feel like this is so complicated. I can't remember it. I understand, but in the future, when you do more and more practices, when you become a professional accountant, it almost becomes the first reaction to you. You don't even have to derive this equation. You don't need to remember the table when I ask you what is what is the side that you have to use when you increase, say, accounts payable, your first reaction will be, oh, accounts payable is a liability account. When I increase accounts payable, I would credit accounts payable. So as I said, it's a language. When people ask you how are you doing today, don't have to remember anything. Your first reaction is that I'm fine, thank you, right? So this is the same idea when we learn accounting and the accounting language.